Your school lied to you about money. Not on purpose, but they did. They taught you to memorize dates, solve equations, write essays, but nobody explained the difference between an asset and a liability. Nobody showed you how money actually flows. And here's the thing, that missing education is why most people work their entire lives and still can't retire comfortably. Robert Kiyosaki's Rich Dad. Poor Dad breaks this down through two father figure, his educated poor dad with a PhD who struggled financially, and his friend's rich dad with an 8th grade education who built serious wealth. Same work ethic, same responsibilities, completely different outcomes. Today you're getting 3 lessons that flip everything you learned about money. Let's start with the one that changes how you see everything you own. Here's the definition nobody teaches in school. Assets put money in your pocket every month. Liabilities take money out of your pocket every month. That's it. Sounds simple. But most people get this backwards their entire lives. Your house? Not an asset. I know that hurts to hear. You've been told your whole life that buying a home is the smartest investment. But think about it. Every month you're writing a check for the mortgage, property taxes, insurance, maintenance. Money's flowing out of your pocket. That's a liability. Now, if you own a rental property and someone else is paying you rent that covers the mortgage plus extra, that's an asset. See the difference? Same thing with your car. The moment you drive it off the lot, it loses value. Then you're paying for the loan, insurance, gas, repairs. It's draining your wallet every single month. That's not an asset. That's an expensive liability you convinced yourself you needed. Real assets are things like rental properties where tenants pay you, businesses that generate profit while you sleep, dividend-paying stocks that send you checks. These put money in your pocket. That's the game. Here's a real example from someone who lived this. 2 physicians, both trained in the 1970s, both sole breadwinners for their families, both worked hard their entire careers. Same profession, similar income. By 2008, their financial situations couldn't have been more different. The first physician, let's call him the poor dad approach, relied entirely on his salary. He saved diligently, built up a nest egg, did everything the traditional advice tells you to do. When the 2008 recession hit, he panicked. He saw his savings dropping and sold his investments at the worst possible time. He lost a huge chunk of what he'd built over decades. The second physician, the rich dad approach, built a portfolio of rental properties over the years. His rental income eventually exceeded his physician's salary. When 2008 hit, he didn't panic. He kept his properties, kept collecting rent, and actually bought more real estate when prices dropped. Today, he works because he wants to, not because he has to. He travels without worrying about time off. And he's passing those income-producing properties to his kids. Same starting point, wildly different endings. The difference? One guy accumulated liabilities thinking they were assets. The other guy focused on actual assets that paid him every month. This is why poor dad thinking keeps you working forever. You buy a bigger house, a nicer car, better stuff, and every purchase increases your monthly expenses. You need your job more than ever. You're trapped. Rich dad thinking flips this. Every dollar you earn goes toward buying things that pay you back. Your expenses stay low while your income grows. Eventually, your assets cover your lifestyle and you're free. But knowing what to buy isn't enough. You need to understand how money actually moves through different types of income. That's where the next lesson comes in. Rich people don't work for money. Money works for them. That sounds like a motivational poster, but there's a specific pattern here that changes everything once you see it. Most people are stuck in what Kiyosaki calls the employee trap. You trade your time for dollars, you get a paycheck, you pay your bills, and at the end of the month, there's nothing left. Next month, you do it again. You're running on a hamster wheel with no way off. The only way to make more money is to work more hours or get a raise. But there's a ceiling to how many hours you have and how high your salary can go. Kiyosaki breaks this down into what he calls the cash flow quadrant. On one side, you've got employees and self-employed people. Both are trading time for money. A doctor who owns his practice might make great money, but the second he stops working, the income stops. He's self-employed, not truly free. On the other side, you've got business owners and investors. Business owners build systems that generate income whether they show up or not. Investors put money into assets that pay them while they sleep. That's the difference. Time and his money are separated. Here's what this looks like in real life. Remember that second physician who built the rental properties? His rental income eventually exceeded his salary. Think about that. He's making more money from assets he bought years ago than from working 50-hour weeks as a doctor. He still practices medicine, but now it's because he enjoys it, not because he needs the paycheck. That's passive income beating active income every single time. This is why chasing a higher salary is a trap if that's your only strategy. You get a raise, you celebrate, and then you increase your lifestyle to match. Bigger house, nicer car, private school for the kids. Your expenses go up with your income, and you're still stuck. You're just stuck at a higher income level. The real move is building income streams that don't require your time. Rental properties, businesses with managers running them, dividend stocks, royalties from something you created once. These pay you, whether you're working, sleeping, or on vacation. Kiyosaki learned this at age 10. He and his friend Mike started working for Mike's dad, the rich dad, for free. No paycheck. Most kids would quit immediately, but that was the lesson. Rich Dad was teaching them to stop thinking like employees. He wanted them to see how businesses actually work, how money flows through systems, how you build something that generates income without trading every hour of your life for it. The lesson stuck. Instead of chasing bigger paychecks, Kiyosaki spent his career building businesses and buying assets. That's the cash flow pattern that actually builds wealth. So, you know what to buy and how money should flow. But there's one skill that makes all of this possible, and it's the skill the education system completely ignores. Here's the brutal truth. Your degree didn't teach you about taxes, debt, or investing. You can have a PhD and still be financially illiterate. Kiyosaki's poor dad had a doctorate in education. Smart guy, worked hard his whole life, and still struggled with money. Why? Because nobody taught him how money actually works. The traditional advice is get good grades, get a good job, work hard, save money, and retire. That advice worked in the 1950s. It doesn't work now. Wages haven't kept up with inflation. Savings accounts pay almost nothing. And central banks print money faster than you can save it, which means your cash loses value just sitting there. Financial education means learning what schools won't teach you: how to read a financial statement, how taxes work differently for employees versus business owners, how to use debt as a tool instead of a trap, how to evaluate investments. These are the skills that actually matter, and you won't find them in a textbook. Kiyosaki learned by doing. He played Monopoly with his rich dad, and that wasn't just a game. It was training. Buy properties, collect rent, build cash flow. The game teaches the pattern. Then he worked in his rich dad's businesses, learning sales, management, and systems. Not specialized skills, broad skills that let you see how everything connects. Here's where it gets interesting. Employees pay the highest taxes because they have no options. Business owners and investors pay less because the tax code is designed to reward people who build businesses and invest in assets. Rich dad could write off his Porsche as a business expense. Poor dad had to buy his car with after-tax dollars. Same car, completely different cost. The Rockefellers understood this. John D. Rockefeller Sr. tracked every single expense in a ledger, even as one of the richest people in history. His granddaughter, Ariana Rockefeller, still does this today. It's not about being cheap. It's about awareness. You can't manage what you don't measure. The risk of overspecialization is real. If you're only good at one narrow thing and the market shifts, you're vulnerable. But if you understand sales, management, finance, and systems, you can adapt, you can lead, you can build. So how do you start? Read books on money and investing. Play cash flow games that teach the patterns. Find mentors who've actually built wealth, not just people with degrees. Take small risks, buy one rental property, start one side business, invest in one dividend stock. Learn by doing, not just by studying. Assets, cash flow, and education. Those are the three pillars. Buy things that pay you, build income streams that don't require your time, and learn the skills schools won't teach. Your Rich Dad education starts now. This month, pick one move, read one financial book, research one rental property, or start one side business. That's how you break free from the employee trap and start building real wealth. Subscribe for more summaries that change how you think and act.